Day trading. When you hear that word, what comes to mind? For a lot of people, it's gambling, right? Fast money, crazy risks, pure luck. But what if we looked at it in a totally different way? Not as a casino, but as a high-performance profession, one that's built on discipline, strategy, and rock-solid execution. So today, let's strip all that away. We're going to walk through the actual blueprint of a professional's trading day, from the very beginning to the very end. Okay, let's get into it.
See, at its core, the market really gives you two choices, two paths you can walk. On one side, you've got the gambler. They're chasing the thrill, hoping for a lucky break, and pretty much ignoring risk. And on the other side, you have the professional. They follow a plan, they manage their risk, and they execute with discipline. Every single person who trades chooses one of these paths, whether they know it or not. And that choice, well, it makes all the difference.
All right, so for the rest of our time here, we are going to walk firmly in the professional shoes. And the focus isn't just going to be on the money, it's about the process, because that's what makes the profits last.
Okay, so where does that process even start? Well, I'll tell you, it's not when the opening bell rings. A pro's day kicks off hours before the market even wakes up, with a meticulous pre-market blueprint that sets the stage for everything that's about to happen.
Now, on the day we're looking at, the picture is, well, it's a little messy. On the global stage, you've got the US Fed sounding hawkish, which could mean higher interest rates. But then, back home, you've got Indian inflation numbers coming in lower than expected, which is great news. So what does that all mean when you mix it together? It screams one thing: volatility. And for a pro, that isn't scary. It's an opportunity you plan for.
So, with that chaotic backdrop, it's time to narrow the focus. We're not chasing dozens of stocks. Nope, just 3 key names on the watch list. First up, Infosys. They just announced a major deal, so we're thinking breakout play. Then there's Reliance. Crude oil is spiking, so the strategy is to see if it can hold a key support level. And finally, HDFC Bank is showing some unusual volume, which could set up a nice mean reversion trade. You see, every stock has a reason, and every stock has a plan.
You see how this all boils down to a simple 4-step process? It's the same every single time. You analyze the cues, you build that focus watch list, you formulate a specific strategy, and this is the big one. You set your risk parameters before you even think about putting a single dollar on the line. The entire plan is locked in before the market's chaos is even unleashed.
All right, the bell rings. The plan is set. Now, it is all about execution. The market just explodes with energy, and our eyes are locked on the first name on that list: Infosys.
But we don't just pile in, right? A pro waits for a clear, predefined signal. So the question is, what is that signal?
And there it is. A classic bullish flag pattern starts to take shape on the 5-minute chart. I mean, it's textbook stuff. A little period of consolidation after a strong move up, and when that buying volume kicks in to confirm the move, that's our trigger. We enter as the price breaks out. No guesswork, no emotion, just seeing the pattern and executing the plan.
Now look at this number. 1%. This might just be the most important rule in this entire blueprint. Basically, you calculate your position size so that if this trade goes completely sideways and hits your stop, the absolute most you can lose from your total capital is just 1%. It's not about being right all the time. It's about making sure you can stay in the game even when you're wrong. This rule is your armor.
And this quote right here, it just nails the entire mindset. You know that 1% rule we just talked about? That's your defense. Your stop loss? That's defense. So many traders only think about offense, how much money they can make. But the pro knows you can't score any points if you're sitting on the bench. Defense is what keeps you in the game.
Okay, so the trade starts moving our way, which is great. But then it stalls. The momentum starts to fade right at a resistance level. Now, the gambler might get greedy and just hope for more. The professional, they adapt. They book some of those profits, locking them in, and then they move the stop loss up to the entry price. Suddenly, the trade is risk-free. Worst case scenario, we break even. Best case, it takes off again.
But of course, the market never just hands it to you, does it? That midday session, it almost always throws a curveball, and today is no different. This is where your ability to adapt really gets put to the test.
And then bam, a headline flashes across the screen: OPEC is signaling output cuts. Crude oil immediately spikes. And just like that, the entire market landscape is changed in a heartbeat, which directly affects our watch list.
So, in the middle of all this new chaos, that trade idea for HDFC Bank, yeah, it's just not working. That volume we saw earlier, it just completely dries up. So the price drifts down, hits our preset stop loss, and we're out. It's a loss, sure, but it's a small, controlled, unemotional loss. The system worked exactly like it was supposed to.
This right here is a huge mental shift every pro has to make. Look, the goal is not to avoid losses. That's impossible. They're going to happen. The goal is to make them totally insignificant. A small controlled loss is just a business expense. It's the big uncontrolled ones that do the real damage.
But here's the thing. That same OPEC news that killed the HDFC trade, it created the perfect opportunity in Reliance, just like we planned for. So first, you get that big spike from the news. Do we chase it? No way. We wait. It pulls back, finds support. That's our entry for the first trade. We scale out profits as it moves up. Later in the day, it pulls back again, but notice it makes a higher low. That's a huge sign of strength, and that's our signal to get back in for a second trade, riding it into the close. 2 separate trades, all part of one disciplined plan.
All right, the closing bell rings. The day's over. But the work isn't. Now comes maybe the most important part of the day, the review. And we're not just looking at the P&L statement, we're looking at the real scorecard. How well did we execute the process?
When you break it all down, the takeaways from the day are crystal clear. That pre-market prep, absolutely non-negotiable. Risk management was the backbone that saved us on that losing trade. Our adaptability allowed us to react in the news and manage our winners. And honestly, through it all, self-control, just sticking to the plan when fear and greed are screaming at you, that's the most underrated skill in this whole game.
So how do we grade today's performance? Let's forget about the profit and loss for just a second. The real score is this, the process adherence score. How well did we stick to the plan? Preparation gets a 95%. Risk management, a perfect 100%. We stuck to our stops, no questions asked. Adaptability gets a 90%. See, this is the real victory. Because profits can have good days and bad days, but a solid process, that's what ensures you're still here to trade tomorrow and the day after that.
So as we wrap this all up, it really boils down to one simple, powerful question you have to ask yourself. When you're in the market, are you managing your trades, or are your emotions, your fear, your greed, managing you? The answer to that, well, that's everything.